Hey Bowtie Nation, Joseph Hogue here, back answering your stock investing questions. We got 73 responses to our community post on your biggest stock market questions right now. And because people hate long videos, I answered 10 questions in our last video, and I'm going to finish up on this one. I'll leave a clickable index to the questions in the description below if you want to skip around a little bit, but check out all of these because, man, these are some great questions covering everything from investing ideas, what do you do when you're losing money, and just everything you want to know about the stock market. Now let's get started, but before we do, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. First question here from J-Dub. Is growth still king? Long-term 50 to 20 years going forward. This is a really interesting question because we did see that change between value and growth stocks over the last decade, over the last 10, even 20 years. Here, this chart goes back to 1983 and shows relative performance of value stocks versus growth stocks. And you see, historically, value stocks have outperformed. And value stocks beat growth stocks by almost 5% a year in the 17 years to 2000, to the year 2000. Those cheaper stocks on that price to earnings basis just have tended to produce higher returns. And it's a big reason why Warren Buffett has done so well for so long. But then look at what happened over the last 20 years, since 2000, and really even more so in this last decade. Growth stocks have started to outperform and just ran away with it. Since 2010, growth stocks have beaten value by almost 3% a year. But now, of course, with the stock crash, growth stocks always fall harder and value has come back in favor. So a lot of investors are asking, do growth stocks reassert that leadership and are the returns over the next decade, or is it value stocks once again? And now first, I think everyone should have some growth stocks and some value in their portfolio. Value stocks usually are more stable, so they're not going to fall quite as much in a crash, and the dividends are great here. Growth stocks, for their part, provide more upside potential, especially if you pick the right one, right? Shares of Amazon are up over 50-fold, 50,000% over the last 20 years, a return that you're never going to find in a growth stock or in a value stock. Now, I do think growth stocks do have a hard time, at least over the next few years. A lot of the performance was just that ultra low interest rate environment, really increasing the valuation for these growth stocks. So as rates go higher and stay there for a while, it's going to be hard for those growth stocks to boom like they did. Our next question from the goofball. I'm not going to call you cute there, bro. On a smaller portfolio where there's only 10 or 15 shares in each position, should I sell out of the winners that are up to help stack money on the sidelines? Dividends would be receiving over the next 4 to 5 quarters don't seem to be enough if the portfolio drops 20, 50%, buy back in later. Okay, now there are a few points here I want to make. First is that it really doesn't matter how many shares of a stock you have, right? If you have even half a share of Amazon when it was trading for $3,000 each, you'd still have $1,500 in a great company, versus let's say if you had 50 shares in Roblox trading at $26 each, which would still only be about $1,300 in your investment. So try not to think about it in terms of, how many shares you can buy, like more is better. Always analyze the investment by that valuation, the growth, and the other fundamentals of the company. Now, second, should you be selling your winning stocks for cash right now or invest in those that are lower? And here, you don't want to sell a stock just because it's up a little bit, just like you wouldn't sell a stock if it's down on the price alone. There is a momentum effect in stocks. The ones that have been doing well often continue to do well, and those that fall continue to fall. So I see too many investors just take their profits too early on their winners, but then clutch onto those losers in that mad hope that they rebound. More importantly, though, is understand you're always evaluating your stocks on that future potential for growth. If a stock is just up past your estimate for a fair value and you think it's tapped out, then yeah, you'd probably want to sell some of that and take some profits. Similarly, though, if a stock is down and it's because of that new information that really changes your reasoning on the valuation, you might want to sell some of that also instead of just sitting on the dead money. Now, there's a whole process behind how to analyze stocks. I answered some of that in our first video on the top first 10 questions, so I'm going to link to that video in the description below. And we're just getting started on your stock investing questions, but I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching in stocks and stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community. So look for that sign up link below. Next question from Edson. Should I sell stocks for a profit and then rebuy again when the stock has bottomed? And this is what everyone is asking right now, right? If we're expecting a recession and for stocks to fall more, why not just sell everything and wait for an all clear signal? And there are a couple of problems, though, that mean while you can do some things to lower your risk and protect your profits, I don't want you just to sell out of everything. One is as clear as the recession signals are, we don't really know for sure. The broader S&P 500 is already down more than 20%, closer to about 25%, while tech and growth stocks are down even more. If we do get some positive news, then it might be that stocks only fall another 5% and start that next bear market. Since no one can call the bottom exactly, you're more likely to wait too long and just miss out on a lot of the rebound potential. Now, that said, I do think it is important to build up cash, so keep making those monthly deposits into your account, but waiting to use that to buy stocks on the lower prices. You can also trim back on maybe some of your marginal positions, those stocks that you really aren't sure about, not for a long term anyway, and aren't in love with them as a long-term investment. So we're seeing a lot of these bear market rallies here where the market rebounds 5 or 10%. And I shared in a recent video that I think those are great opportunities to trim back some of those stocks that you're not holding for the long term. This is going to do two things for you. It's going to help build up cash for the stocks that you really do like later, but plus those stocks that you really aren't sure about anyway, those are going to cost you the most stress as they fall further because you're kind of on the fence about holding them anyway. But definitely don't just panic and sell out of all your stocks, okay? I've seen too many investors just leave the market in these crashes and then wait too long to get back in, or when they do start investing again, they find their expenses have increased because they're not saving any money back, right? And it's so much harder to get back in that habit of saving and investing again. Next question from Stephen Bishop. I would like to know about fractional shares. Is it better to buy fractionally or save up for a full share purchase? My broker doesn't allow fractional shares. Is that a bad thing? Okay, important question. And I'm surprised more investing sites don't do this, don't allow for those fractional share investing, because it really does open up a whole new world for investors. Without those fractional shares, you need to save up enough to buy a whole share or more of a stock. And that can be impossible for stocks like maybe Warren Buffett's Berkshire Hathaway at $424,000 a share, or even some of the lower price names like Tesla or Amazon at hundreds of dollars each. And with fractional shares, though, you can invest any amount you want in any stock. So your broker is going to access a pool of the shares and put a fraction of that share in your account according to how much you invest. So say maybe you invest $100 in Tesla here at $650 a share. That would mean you'll get about 15% of a share of Tesla, or 100 divided by 650, into your account. And this is no different from any other type of investing, right? Your portion of a share is still going to go up or down in exactly the same percentages as that whole stock. You can sell or add to your partial share anytime you want. It's just a great service, because otherwise a lot of investors would just be locked out of those higher price stocks and some really great companies. Now, if your broker doesn't offer fractional share investing, I wouldn't say it's a deal breaker, but they better be offering like some other really great services that you really love. Otherwise, I'll leave a few links in the description below. Investing apps that I use, like Webull and M1 Finance, those both offer fractional share investing. Next question is from Rick. How do you combat fear of investing in the stock market? Now, this is an interesting question, and I don't know if he's asking about the general fear of investing, so just that fear of losing your hard-earned money in uncertain stocks, or maybe the additional fear we see right now in this stock market crash. So I'm going to try to address both of these. First, on that just general fear of losing your money and the uncertainty in the stock market, there is just no doubt that stocks are the single best return for investors. Yes, you can create a business and see much higher return on that, but for this lower level of risk and the fact that you just don't have to do anything with a stock after you buy it. So an idea of passive returns, there's just nothing that compares with stocks. You only need to look at a 20 or a 30-year chart of the S&P 500, or even individual stocks like Microsoft or Apple, to see that the stocks are the best investment out there. Now, that said, there is the risk that any individual stock loses your money. And that's why investors put their money in multiple stocks and in funds, ETFs, that hold thousands of stocks. Those of you in the nation know I always recommend the core satellite strategy, where you're investing maybe half or more of your money in these broad, diversified ETFs that hold hundreds and even thousands of stocks. Those are funds like maybe the ProShares Dividend Aristocrats ETF, that's ticker NOBL, or the Vanguard Real Estate ETF, ticker VNQ, for that real estate exposure, and maybe even the Vanguard Short-Term Bond Fund, ticker BSV, for those bonds. These are going to give you that broad exposure into the asset classes and those market returns without the risk of individual stocks. Now, with half or more of your money in maybe 3 or 5 funds, then you know you're getting that market return and don't even have to worry about it, really. With the rest of your money, you can then invest in that handful of individual stocks. But since you've only got maybe 3 or 5% of your money in each individual stock, even a bankruptcy in any single stock isn't going to destroy your portfolio. Now, for when we are stuck in a bear market crash and falling stock prices like we are now, here I really think investors need to check their perception on these. Yes, it sucks to see your stocks fall, and it can be painful, physically and emotionally painful, believe me. But over more than 20 years investing and more than a decade as an analyst, I've learned the best returns and the best investments are made right now. It's only when stock prices have crashed 20 and 30% or more that you're getting the best prices on those long-term investments that are going to earn you 15 and 20% a year over the next decade. And also understand that when we do see these bear markets, these stock market crashes, it's not just the overvalued stocks or the bad companies that fall. Everything is going to fall. Everything is going to crash lower. So those companies that you love long-term that maybe you're a little more disillusioned with right now because they have started falling, those can still be great long-term investments. And some of the growth stocks that have come down 80% and more, they're still growth companies posting 20 and 30% sales growth every year. So just do not sell out of your long-term stocks because a little short-term pain here, right? Because those stocks are going to rebound fast when the market recovers. We've still got 5 more stock investing questions to highlight, but if you want to see which stocks I'm buying, the 7 biggest stocks in my portfolio, click through the link I'll leave in the description. This is a free report I put together with The Motley Fool. It's absolutely free, no obligation. Now, The Motley Fool is going to email you an offer for their Stock Advisor newsletter. I use it, I like the analysis, but there is no obligation to buy anything, none. So look for the link below, get your free report, and you'll be helping support the channel, so I do appreciate it. Next question here from Deer in Fear, another longtime citizen of the Bowtie Nation, so great to see you here. I understand you need a strategy. I've struggled with this, which is not good. For example, I own Dine Brands, bought it at 32, it's at 75. I only have 90 shares and get a whole $46 dividend. I keep on thinking I should sell and take my profits and reinvest elsewhere. Do I wait for a possible $100 a share like the forecasters are saying? I hope you understand what I'm trying to ask. I'm not hooked on the company, but I know it is profitable, all dependent on inflation and food issues, so think investors of stocks, nice profit, I guess, the video for guidance or advice or understanding, blah, blah, blah. Okay, I love it. Sometimes you just have to brain dump what you're thinking to get a handle on it. And I love that we're able to do that for each other in the community. There are a few questions here that I think are important. I want to point out here. One is that dividend yield is almost 3%, so it's not a bad yield, about twice the market average. But if you're not investing in it for that cash flow, I would ask if the growth potential is going to make up for that. And here it really sounds like it's kind of a marginal investment, that you're not sure about, and definitely not a long-term hold. For these, I would think about taking some profits to help build up that cash to invest in those longer-term holds. Now, the bigger picture here is that these short-term stocks, the investments that you really don't have that long-term confidence in, these are the ones that are going to cause you the most stress, especially in a bear market. And it's usually just not worth it, folks. I love picking stocks and investing, but if your portfolio is causing you to lose sleep, then you're going to end up making those bad decisions, those rushed decisions, because you're not in the right mindset. The best thing you can do is just ask yourself, which are the 10 or 15 or maybe even 20 stocks at the most that I really think are the best companies in their industry and that I want to hold for decades. Cut back to those, plus maybe a handful of ETFs that they're going to give you that diversified exposure to stocks, bonds, and real estate for the market returns, and you're going to see your stress level just plunge, right? Like eating a Valium sandwich and getting a massage level of lower stress. Next question is from Michael. Do you have a backup plan for 10 years down the road if the Fed can't get inflation under control and the dollar is eroded away? It's one of the things that keeps me from going all in on dividend stocks. Continuing to buy 50% stocks, 50% precious metals every week. Thoughts? Thanks for all you do. All right, great question. Thanks for that, Michael. Kind of a black swan thought experiment I think every investor needs to do with their portfolio. What are the extreme outcomes in the market that could surprise everyone? And here I want to cover 2 potential outcomes, right? What it means for your investments and really how to invest. And first is if we do see that persistently high inflation like we did in the 70s, here we see the inflation really started to move higher in the late 60s, dipped a little bit, but then jumped to 12.5% a year by 1975. It looked like it was coming under control for a few years, coming back down to about 5% a year, but then jumped again, peaking at 15% in 1980, and didn't come back under 3% until 1983 and a massive recession. And right now, based on pricing for Treasury securities, the market and the Fed is expecting inflation to come way down really fast. The green line here is from the Federal Reserve Bank of Cleveland, and it estimates the expected rate of inflation over the next 10 years. And you can see here, it's expected to be just 2.4%. Now, I do expect inflation to start coming down later this year, and a recession next year is going to bring it down further. But I also think it's going to be over 3 or 4% at least for a few years. And there is a possibility that inflation stays higher even for longer. Now, that really leads us into our second potential outcome, which would be a secular bear market that lasts more than a few years. This is a chart of the S&P 500 since 1930, and a lot of investors don't believe stocks can stagnate for years, but it does happen. We see 3 periods here in these boxes where essentially stocks went nowhere for 10 to 15 years. That is called a secular bear market, something we talked about in our Monday live stream a few weeks ago. So both or either of these outcomes is possible, though it's not what we're expecting right now. I do want to give you 4 tips on how to invest just in case. First is you do want exposure to real assets like real estate and commodities. These do well against inflation because they are those physical assets like property or metals and agricultural products. So here I'm thinking real estate stocks like with some of the REITs that we talk about on the channel, or even direct exposure to property. You can also buy commodity ETFs like the Invesco Commodity Tracking Fund, that's the ticker DBC, or the Invesco Agricultural Fund, ticker DBA. Now, something else we've talked about on the channel lately is that formalized strategy, that written strategy of holding some cash back for those deeper drop in stocks, waiting until the stock market falls to certain points to invest parts of your cash. That might even mean waiting as much as 45% down from the peak of last year for some of it. It might not be the absolute bottom in stocks, but it is going to save some of your cash back instead of what a lot of investors are doing, which is just getting stressed out, watching the market go down every day and eventually just going all in before stocks are even near a bottom. And so even if we do see that secular bear market like you see in the chart here again, you can still make money if you invest as stocks find those bottoms. Now, this next one is going to be controversial, but I'd also say you cannot be afraid of debt. Yes, the average 30-year mortgage rate has jumped this year, but it's still relatively low versus history. Rates before 2010 were typically 7% and higher, especially in that high inflation period of the 70s and 80s. Even at a 6% mortgage, though, if inflation does stay high and let's say even comes down to 5% inflation a year, the real cost of that loan is only 1% because you're paying it back after inflation. Now, finally here on this, and this isn't going to sound like some big secret, but a secular bear market where we do see stocks go nowhere for like a decade or more is going to severely test investors. It does happen though, but the thing to remember is you can still make money. By continuing to invest through that bear market, you're getting stocks at those lower prices. Your dollar cost averaging down on your long-term stocks. And when the bull market does return, those returns are going to be huge. Question here from Octavius, is technical analysis useful? So technical analysis, it's very useful for stock trading, right? I know day traders that use nothing but technical analysis. And for the longer term trading, stock investing, not as much, but I do like to use it for when to buy. For example, if I'm watching a stock to buy, instead of just rushing in to invest, I might wait for the stock to break through some momentum signals or show oversold on that RSI indicator. It's not a guarantee, but most of the time, this really just helps me start off a stock on the upside. You make sure I'm getting a good price for it and then holding it on for those longer term gains. Now, for stock analysis, you've got to understand, though, most of the fundamental analysis that we do here on the channel is really only relevant for that long-term picture, that 3+ years of holding a stock. That's when those best stocks on the sales growth, operating margins, the profitability, and these other factors are really going to show up in the returns. For that shorter term investing, especially anything less than a year holding a stock, it is all about investor sentiment and some of these other technical analysis indicators like momentum. That's where it's important to follow those chart patterns on a stock when you're going to be trading it or holding it less than a year. This one is that banking stocks in the long term still hot even right after inflation is good for high Fed rates. What stocks or businesses should we buy? Condition energy costs high and disruption food chain because the war is still going on. Okay, a couple questions here. The first is, are bank stocks still a good investment? And I have liked banks over the last few months now. They've come down a little bit with the rest of the market on just a fear the recession is going to increase loan defaults, but consumers and corporate bank accounts are still very strong. Earnings by the banks last quarter showed deposits are still increasing. So I think even with a recession, you're not going to see a jump in loan defaults as high as it's expected, and the banks will do well. And with higher interest rates, banks are making more money on their new loans, and the valuations have come down way down on these. Your shares of Citigroup, which Warren Buffett recently bought, are a big block, and those are trading for a price of just 0.54 times book value. And Goldman Sachs is trading at a book value per share lower than I've ever seen it. Now, for the best stocks to buy in inflation, here again, I would focus on some real estate exposure, commodities, and just the companies with that higher pricing power, like your drug makers. I highlighted shares of Kellogg in an April video on the best inflation-fighting stocks. I'll link to that in the description below, along with Biogen and Saber Healthcare. All three of these which are beating the market since. And here, that food insecurity issue is likely to be one of the biggest themes over the next few years. The UN Food Price Index has surged more than 30% in the last year, and this is already causing riots in Latin America, Middle East, and Africa, and could spread as things get worse. We actually did a video in May covering the stocks to invest in these themes, themes like Archer Daniels Midland, ticker ADM, a Mosaic Company, ticker MOS, but I'm going to link to that video in the description below, so make sure you check that out. Click on the video to the right for the first 10 stock investing questions we covered. Check that out because you really do need to answer these before you invest your money. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.